If you are SMC or ICT trader yet still failing at trading and cannot be profitable, then know you're always failing into a smart money trap. As a smart money concept is getting more popular, a lot of people thinking they trade SMC, but they are doing nothing but recognizing patterns and creating liquidity for others. In this video, I'll go deeper into smart money trap and show you 7 traps you're failing into that I can assure you you're failing in some of those without being aware. Make sure to stick until the end of the video because the last 2 are so important. This is Mulham and let's get into it. So let's start with this. Let's see if this video is for you or not. So if you're someone who always look for a liquidity sweep, then for a market section shift for price to go up with a displacement, then when price comes back to, let's say, an imbalance or a fair value gap, as price comes here, you get a reaction to the upside, but eventually price started going lower, and here is your stop loss. Price always goes to your stop loss and then reverse from here. If you're falling into this trap, then make sure to keep watching, as I'll give you again 7 traps that you're failing that are part of this, and they happen all the time. So starting with the first smart money trap, which is a big fair value gap. So a lot of people don't pay attention to those big fair value gaps. However, if you go back to your journal or you go back to wherever you save your trades, you're going to notice that you actually get stopped a lot of the times in this case or in this big fair value gap. So let's say that price is coming lower, and then at some point there was some high impact news going up, then coming lower. This was a big displacement leaving a big fair value gap. In this price action, a lot of people, and here is the smart money trap. What people do is thinking that, so let's assume that this is a 4-hour, right? This is a 4-hour fair value gap. People would go to the lower time frame, which is in this case a 15-minute, because that's the right alignment. People would look for any market section shift as soon as price comes to that fair value gap, and then they're gonna assume that, okay, we're starting to go up now. But eventually price will go lower. And again, what's gonna happen again is price going up, another market section shift to the upside, going lower. So price is going to go deeper and deeper into that fair value gap. I'm going to teach you how to actually spot that reversal, the accurate one. I'll show you where to actually, or some indications on where price is going to have that real reversal, but it's going to be very tricky sometimes. So make sure to keep watching on the next 2 minutes. Now, this is what's going to happen. Price is going to go lower, market section shift going lower. And then people, any change of state delivery, they're going to interform, but eventually price is going to go lower. Now, one example of this is, let's say this is a 4-hour. We had a high impact news here, and we had this big fair value gap. Now, anytime price will come back to that fair value gap, any lower time frame entry here, people would enter, but that's clearly a smart money trap. One of the reasons is this fair value gap not being fully filled. And that's one of the reasons that price will keep going deeper and deeper into that fair value gap. But let's watch the price action, right? Let's see what happened. So price still did not go back to that fair value gap, did not retrace.
Our sponsor, Blue Guardian, is the only firm that gives you a tool to protect yourself from hitting your max daily loss and prevent you from overtrading. And it is very simple to use. They also have a new unlimited time evaluation with low profit targets and no trading days requirement, so you can get funded in the same day. Blue Guardian is a firm that I trust. Use the link in the description below and use the code MULHAM to get 10% off your next Blue Guardian evaluation.
That's the first retracement into that fair value gap. And what a lot of people are doing now, even if I go to that 15 minutes, I would notice that they might be having market section shift here. So what we see here is, okay, there you go. We had this low taken here with a market section shift. But then even if you entered on the 15 minutes, targeting the 4-hour structure, or simply if you're looking for the real expansion, maybe you're going to get some profits here temporarily because this is still the short-term move, but it's not going to be the real move. Now, if you're aiming for example, this 4-hour fair value gap, I doubt it's going to go there because that's not, in this case, there was another confirmation of price going up, but not all of the confirmation. Now let's see price starting to retrace, going lower. And what happened here? Another sweep where into the fair value gap. So anyone who actually entered on this reversal or this 4-hour change of state delivery, then price started reversing lower, sweeping that low. where there's a lot of stop losses here. Now let's see what happened after. Price again went up, and even for people who are looking at the 4 hour, what they're gonna say is, okay, this is a market session shift on the 4 hour. But let's see if that's true. So price started going lower. Price came to the fair value gap, did not give a lot of profit, actually reversed from that fair value gap. The bearish one started going lower. Are we gonna take that low? Let's see. Not yet. And there you go. Another sweep into that fair value gap. So if you trade here and your take profit is around that 4 hour external liquidity, the real move did not happen until I think here. So let's see, let's play the price action, and then the real move happened here, started happening after the sweep. So how to spot this sweep, right? Because what happened here is this first move, second move, third move. If you keep entering after those are 2 losing trades. And let's forget about some other potential losing trades, but only this. If you entered here and here, those are 2 trades. How to avoid that? Now, how I see price action, and this is only based on my view on the price action, there are 5 indications in order to predict when this is going to happen. Actually, the first one is one that I've talked about a lot of the time, especially when we have big fair value gaps, is what? The 3 drive pattern. So in any fair value gap, a big one or a small one, a lot of the time price is not going to go to that. So let's say price is coming back to that fair value gap. It's not going to be the first move or reaction from the fair value gap. It's not going to be from the second reaction of fair value gap. The real move, a lot of the time, is going to be happening from the third touch on the fair value gap. So you see 1, 2, 3. A lot of the time, the third touch is the real one. The third drive is the real one. That's what happened here, actually. So first move, second one, third one was the real one. So using a 3 drive pattern, either in a bullish scenario or a bearish scenario, is going to tell you and give you an indication when the real move is going to happen. Another one is when the fair value gap is fully filled. Obviously, it was not fully filled here, but if we see that first one, second one, and the third one was filling the whole fair value gap, then we're going to know for sure, not for sure, but 90% that price is now going up. That's another indication, which is the fair value gap being fully filled. Now, another one, and this is a very important one, and it really makes you actually spot that sweet reversal, the clear one, which is the overlapping. So when we have a fair value gap that is created here, but then at the same time, we actually broke above an old high here. So there was a high that we broke above. That's an overlapping of a fair value gap and a high with each other. This is where they overlap. This is the previous high. So let's say something like this. That's the previous high. And then we broke above. That's the overlapping. A lot of the time, if the third move, especially the third move, it happens at the overlapping, that's a confirmed reversal. So we confirmed the reversal after this happened. One example, I believe, was, so this one was also all around the overlapping. So overlapping here, that's where it happened, even though it happened after. So you see, the third one happened on the overlapping, and it was a clean one. Now, also, if we go to the lower time frame, let's say 1 hour here, and you know, one by one you went to the lower time frame, you're gonna notice that if you just focus on the extreme fair value gap, it's gonna refine your entry more. So in this case, it was only a singular fair value gap. However, on some examples that I'm gonna go over just in a minute, price decided to ignore all of the other fair value gaps and only go to the extreme one. So one example of where price actually respected the overlapping is this one. So we have a daily fair value gap. That is a big one, very huge one. And price was trading in this fair value gap for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. 9 days price is inside of this fair value gap. Imagine how many times you were going long, and how many times you were losing. And I'm pretty sure if you go back to this price action, you'd be losing some time. How me and the people in Discord, the family there, how were we able to spot where the reversal is going to happen? Only one reason. And I mentioned that the overlapping. So we had two overlappings here. And actually, if we go to the 4 hour, they're going to be more clear. The first one is the highest overlapping, which is right here. The second one is the more refined overlapping, which is this high inside of this fair value gap. Now, I just wanted to see, where did the reversal happen? I mean, one reversal and we made money from is this one. The other reversal, which was almost a sniper entry, a very sniper entry on the 4 hour. Look at this. There you go. That's the one. Very nice entry on the 4 hour sniper entry that came from the overlapping. So any change of state delivery at those levels, we go up. Otherwise, if you traded any change of state delivery other than those, you're going to be losing. So this one, price only came here to the bearish fair value gap, started going lower. Another one going up, going lower. This one was profitable. This one was profitable. The other ones are not really that profitable. Now, one more thing I want you to also keep an eye at. Let's say this fair value gap was created in New York session, then I want it to be filled in the New York session, right? If it was filled on London session, I would expect not the big move, maybe a small move to the upside, but then the real move is going to happen when? On the London kill zone. So you see, we could be using the 90-minute time frame, we could be using the 4 hour, but I want this to be happening, let's say on the New York kill zone. I want it to be filled, and the real move most of the time is going to happen on the New York kill zone. So a lot of information here, because this is one of the most important smart money trap, very significant one that a lot of people are failing into without being aware. They don't realize that they're losing because of those big gaps, and they don't know how to deal with those. So this is the way into the second smart money trap, which is the no inducement trap. So let's assume that we have a structure here, right? Sweeping liquidity going up, and on this structure, price started going lower. I'm gonna be analyzing this structure. Do we have any major inducement or any major liquidity for our entry? So let's say we have an inducement here. As price is going into a fair value gap, we have an inducement into the way. Why? Because now we have two things pushing price higher. And a rule that I have, I don't validate price rebalancing a fair value gap unless there is a liquidity on the way in this range. If there is no inducement that is very clear, then I don't trade this range. I always wait for the inducement to be created, maybe here going up. Then this is my inducement. If price decided to come lower, if there is some weakness here, I could go long from here, right? So no inducement, no entry. And why? Because if there was no inducement, simply you would be the inducement. So let's say that in this whole range from here to here, there was no inducement and there was a clear fair value gap here. What could happen is price coming lower, showing a reaction from here, but then going lower all the way to the low, because that's the only inducement that is available in the market. There is no fuel in the market on the way as price is coming lower. Therefore, price will decide to go all the way to this low. That's the logic behind this. Now, for example, an example of range that I'm not going to be trading is this one. You see how price started going up from here all the way up, and just looking at this specific price action here, there was actually no inducement. There was this one, but it's not really a major inducement, right? So this is the only pullback that is available on this range. Otherwise, there's nothing that is worth it to enter from here, because price was literally going up. If it was coming lower here, I'd be expecting price to take this low. That's one of the scenarios. Now, another scenario is this one here. So you see, as price is coming lower from here to here, this price action here, did we have a major inducement? There was really nothing. On the premium side of this range, there was nothing. There was this fair value gap, but is there a liquidity that is, for example, below that fair value gap? There's really nothing. That's why small move here to the downside, then taking the high, because that's the only available liquidity on the market at the moment. There was nothing here. There was no inducement, a major one that convinced people to go short. Now, exactly the same thing here. Do we have in this big range, did we have a major pullback that we could be using? And it should be on the premium side, right? There is really nothing. There was no major pullback, for example, on the premium side, there was nothing like this, and then price started going lower. If there was this, then this is going to be my inducement, and I could enter from here. But eventually price took the high of the range because there is no other liquidity. Now, for example, looking at this range, big range, as price is going up, the only inducement in the market that was available is this one. But there was nothing here. So in this big fair value gap, no inducement, no entry. Here, there was a inducement. We could actually enter from here. Small move, but it was not even on the extreme fair value gap. It was not near that. It was not on pure discount, right? So that's one of the things to avoid. If we have a structure with no inducement, we avoid that because eventually price will tend to target the highs and lows of the range because that's the only fuel of the market. If there is no inducement that is taken, or in other words, if there is no liquidity that is taken on the way of price rebalancing your fair value gap, then no one thing you are the liquidity. And now into the third smart money trap, which is big structure to small structure. So let's imagine that price is going in this structure here, and this mistake, it's mostly being taken by people who are following the mechanical way for the market structure, or the people for the structure mapping. So people who always mark their market structure in a mechanical way, that's a mistake they're doing, because if they're being mechanical, they're gonna fall into this. But at least you know that, okay, when you see this, it's a lower probability condition. So let's say price is moving in this structure, right? So there was a breakout structure, for example, we went lower, we broke structure again, and then we had this, another breakout structure to the upside. So there was a breakout structure here, there was one here, and there was one here. You see how big the structure from here to here is? You see how big the structure from here to here is? Then, because they're following a mechanical way for identifying the pullback and the breakout structure, this is also a breakout structure. What they do is they look for, when the breakout structure happened, they look for a fair value gap. When the breakout structure happened, they look for a fair value gap. This one was not filled. And eventually we had this breakout structure and then a fair value gap here. People with a mechanical way of trading the market structure, they're going to look at this fair value gap, and that's a smart money trap. What's going to happen instead is price taking the low of the market structure. So what's going to happen is this, price going lower, taking the low, and then going up. Or it's going to go and the same as a 3-drive pattern. They have a big fair value gap here that also people of the market structure are ignoring. Price is going to go all the way to the fair value gap and then go up. This happen a lot of the time. People who are using the market structure the mechanical way, they're going to fall into this. One example of this is, for example, let's say this price action here, breakout structure here going up, right? And then we had a small pullback, another breakout structure to the upside. So if you look on the lower time frame, or even on the same time frame, we had a fair value gap here. So that what they're gonna say is, okay, a breakout structure with a fair value gap, that's what we are gonna be trading. However, what happened is there was another fair value gap here where price tested here for the first time, second time fully fill it, then price decided to come again and again. So the breakout structure was not really that significant when we move from a big range, which is from here to here, and then from here to here. You see the difference between the ranges, and I've discussed this on details on my video about the market structure. Market structure doesn't work, so make sure to also watch that video. It happened over and over. So on another example, if we see here, we started from here, a breakout structure here going up. This is the extreme fair value gap. So this was the extreme fair value gap. However, as we're going up, we had this pullback and going up with a breakout structure. So any entry from here will give you nothing. There was another breakout structure here, but you see the low of this breakout structure was taken. The low of this breakout structure was taken, going where? All the way to the extreme fair value gap. That's the real market structure. It's not any breakout structure. Then we look at the strong highs and strong lows, and then the fair value gap in between. No, that's totally not accurate. So avoid trading with those market structure and trust the inducement and the liquidity. It's all about liquidity. It's more than a market structure. Market structure is not perfect. Now into the fourth smart money trap, which is the fake market structure shift. Now I wanted to make a whole video about this, but at least today I would mention it, give a brief information about it, not in details. I'm not going to go deep into it. And then there's going to be a new video about my theory about the fake market structure shift. So this is Mulham trading theory on the market structure shift, on the fake one actually. So what we see is price is going up, right? Coming lower, going up, coming lower. And we all know that this is a market structure shift, right? Because we took liquidity and then we broke a structure. There was a market structure shift to the downside. So that's a market structure shift. However, it's not always a valid market structure shift. Now let's ask this question. What is the best time for the algorithm to give a fake market structure shift here? What is a fake market structure shift here? It's nothing but grabbing liquidity from the nearest low. So this is the nearest low. The algorithm decided to grab some liquidity here in order to go up. So what is the reason? If there was a clear draw in liquidity here, it's the main one, it's not a minor one, it's the most significant draw in liquidity, let's say on the daily, on the weekly, on the monthly, right? So what's gonna happen before price reaching this, we're gonna be experiencing a lot of fake market structure. So you see fair value gap here, a lot of people would be looking for this market structure shift, price going back into the fair value gap, a small move to the downside, then going up and taking their trades. Step by step going to that drawn liquidity. And again, we could have another fake market structure, right? So something like this before taking the main drawn liquidity. So market structure shift, because at the end, the algorithm needs some liquidity in order to reach that main drawn liquidity, right? So we have again this fair value gap. We have as soon as price goes to that fair value gap, the orders are triggered, price started going lower. People have faith that, okay, this is a valid market structure. A lot of stop losses above here and above the fair value gap and above the swing high. Then what happened after is price started going up, going where? To the main drawn liquidity. There you go. So the Mulham trading theory is that around a main drawn liquidity, we're going to be having a lot of fake market structure shift. Those fake market structure shift could be used in order to enter to that main drawn liquidity. And mainly this is going to be a second stage of distribution or accumulation on a market maker's model. So price will retrace, or there's going to be a liquidity sweep or a fake market structure shift into a fair value gap going up. And again, it's going to happen over and over for some time before price reaching the main drawn liquidity, because a lot of the time price would be expanding a lot to the upside and is getting tired. There is a lack of liquidity, so the algorithm needs to create some liquidity, or at least the market makers need to create some liquidity, convince people to go short, convince people that there is a market structure shift here in order to go short, in order to have some liquidity above those highs to be taken later as a fuel in order to go up. That's how we have the displacement. It's always above highs and lows, right? Because now we have a lot of money above those highs. So that's the way. I'm not going to go in details about this, but this happened all the time before price reaching a main drawn liquidity on, a higher time frame. On the lower time frame, we're going to be experiencing a lot of fake market structure. So for example, when looking at this was a very clear internal to external move. This was our target, which is the external high. Now, if we switch to 5 minutes, for example, we want to look at how price was behaving before reaching the main drawn liquidity. So price was really close to that main drawn liquidity. Let's see how it behaves near that level. So you see, as price was coming close to that level, market structure shift, a fake one into a fair value gap, going up, again going up, a fake market structure shift into a fair value gap, another fake one, going up, now hanging around here, fake market structure shift, going up, another fake market structure shift, going up, price coming to a fair value gap, price were entering based on changes to delivery, we're losing here, going up until it reaches the main drawn liquidity. So you see how many times we had a market structure shift and they were all fake because there was a very clear draw in liquidity that has to be hit. Now the fifth smart money trap is the higher time frame trap. So let's take a look at this, right? This is gold on the 5 minutes. a perfect trade here. Liquidity sweep perfect 2022 mentorship model. Perfect sweep here. Price did not even close below this level. Started going up. What do we have above? A market structure shift. Do we have a fair value gap? Now, even if you're not looking at a market structure shift, what is this here? A fair value gap. So a liquidity sweep followed by a displacement and a fair value gap. You can actually enter from here or wait for the market structure shift to happen and then another move to the lower side into the fair value gap, right? So that's, in my opinion, a perfect entry. Now let's play this, right? And we can see now price is coming back into the fair value gap. We get the entry here and then let's see, price started going up and then going lower. Take my stop loss. What do you think is the reason behind this? There's only one thing that is behind this. Now, 5 minutes, if we switch to the time frame that is aligned with the 5 minutes, which is the 1 hour, simply, what do we see here? As price was going up, offered this fair value gap, price was only moving up, not for a market structure shift, which was here, but only price filling this bearish fair value gap. Price was only going up to this fair value gap in order to fill this fair value gap to go lower. We were actually in a bearish fair value gap on the higher time frame. Higher time frame is what matters the most. So let's imagine that we have a fair value gap here that is bullish, right? And somehow we're coming lower on the lower time frame. We're coming lower here, and we had a breaker structure here, right? A breaker structure and a fair value gap that is, in this case, a bearish fair value gap. Do we take a trade from here? If you're only looking at the lower time frame, then yes, that's a valid one on the lower time frame. But on the higher time frame, we're actually in a bullish fair value gap. This bullish fair value gap pushes price higher, not lower. So this is invalid. This is all wrong. This is only a short-term move. The real move will happen when we go up and give a fair value gap here. That's the real move. All of the other entries that are bearish, they're not valid. Why? Because the lower time frame and the higher time frame are not in alignment. That's all. So all those trades, this one, and even if we get a bullish entry here, it's not valid. For example, this bullish fair value gap on the 1 hour, if we go to 5 minutes here and look for a short entry, it's not going to be valid. The same thing goes, for example, here in this bullish fair value gap. So any short entry is not valid. We only look for longs. So that's the higher time frame trap. Even though it's very simple, very easy, yet a lot of people fail into this and they always make this mistake. So if you just take a second to switch to a higher time frame, look at your structure on the higher time frame, just check if you are in a bullish or bearish fair value gap and follow that direction on the lower time frame. Now into the 6th smart money trap, which is the liquidity sweep trap. So a lot of people assume that any high, right, or not any, but every high and low is a liquidity, and that's true. However, not every high and low is where a liquidity sweep is going to happen. So what is a liquidity sweep? It's price literally taking that high or the liquidity above the high and then immediately reversing. That's not going to be the case with every high and low. And that's what a lot of people, especially beginners, they assume that every high and low is going to be a liquidity sweep, and we always look to short in the other direction. What they don't know is that there's sometimes there's going to be a liquidity sweep. On another time, there's going to be a liquidity run. Now, what is the difference between the two? A liquidity sweep is taking that high and then reversing immediately. A liquidity run, on the other hand, is taking that high. So we want to take the liquidity above, but not necessarily going lower immediately. We could be going up like this and then reversing or going lower. Now, a lot of the time when we have a liquidity run, it means that we want to continue. I mean, we want to take the liquidity, yes, for sure, but then we want to continue to the upside again. So we could be having this high overlapping with the fair value gap, then continuing up, where a lot of people would be waiting for this fair value gap to enter short, which is going to be disrespected going up, right? Because the right direction is this, where the liquidity run happen, on the direction of the liquidity run, which is to the upside. So to differentiate between liquidity run and a liquidity sweep is very important to know what the direction is, very important to avoid some of the bad trades, and very important to actually differentiate between where a reversal is going to happen, where a continuation is going to happen. Now, another thing, and this is a very important, is when we have, let's say, a high, right? So that's a high. We don't validate, and that's what a lot of people think, right? Any high or low, there's going to be a liquidity sweep. But in order to identify the best opportunity for a liquidity sweep, we need to have those two things together. The first thing is a fair value gap or any point of interest, any PD array, and then we need to have a high. When those two things are next to each other and very close to each other, we can now expect this high not to be actually, there's no liquidity run, but instead a liquidity sweep. So what I'm expecting is this high to be taken into the fair value gap to go lower immediately in this direction. So now a short is valid. On the other hand, if there is no fair value gap and there is no immediate reversal after price taking the high, then I would be expecting what? A liquidity run. And what I'd be expecting is something like this. Going up, going up, going up. Then maybe a fair value gap here with an overlapping. Price coming lower, going up again. So that's one of the most important concepts to understand because it's going to filter out a lot of the bad trades. That's first. Second thing is going to tell you what the real direction is. Are we going up after taking the high or are we reversing after taking the high? Now, some examples. So first of all, I want to discuss the high probability liquidity sweep. So one question here, why? So we have a lot of highs and lows, right? Why did this low, when taken, we did not have a real move and then we start going lower? Why this low, when taken, we did not have a real move? However, when we took this low, it was the real move. What's the reason? The reason is there is a fair value gap that is below this low. Price was doing two things at this time, sweeping liquidity and rebalancing fair value gap. The same thing goes here. So why this one? Not really that much. We did not have a big move after. Why? I mean, it's a big move for the 1 hour, but if we compare this to another time frame, then it's not going to be a huge move. Why? The only reason is there is a fair value gap that is below it. Now, looking at another example of a liquidity run, which is, you see this low here, we closed below it and we had a fair value gap here. So we had a closure and price was actually displacing below that low. There is no fair value gap here to push price higher. What happened, therefore, is this fair value gap on the other direction when the low is taken. So a lot of people would be what? Going up, waiting for a fair value gap here. And actually, there was a fair value gap here, which did not hold, and price did move to where? To the lower side. Now there is a high probability liquidity sweep here in the direction of the liquidity run, which is this high. And then we have this fair value gap here. And that's a perfect liquidity sweep. And I took this in the Discord with everyone in the Discord. This was high impact news. It was CBI, I guess. We took this one here because it was very clear. We had a liquidity run here, started displacing below with a fair value gap and overlapping. And then we created an inducement. We started going lower after that. So that's how you differentiate between the liquidity run, liquidity sweep, and this is how you catch a high probability liquidity sweeps. The seventh and the last smart money trap is time. So a lot of the time, and this is not specifically a smart money trap, but I would say be careful with this because you're also losing trades because of this, okay? Or at least you're not entering on the exact time or in the perfect time. Okay, so let's imagine that we have price action on New York created a fair value gap. So a bullish, say this bullish fair value gap on New York kill zone. Okay, and then what happened after that is on the next day, price was doing this. Price came to this fair value gap on Asian session, started going up, eventually went back again. So if you entered here, even if there was a market session shift, you still lost this trade. Now price is coming back to this fair value gap on the London kill zone. However, still not holding. You lose some trades here. So lost a trade. And then New York came into that fair value gap and then the real move start happening here. Now, regardless of the 3-drive pattern, regardless of everything, let's say this is not really a big fair value gap. However, the real move start here. And why? Because of the 90-minute cycle and because of time and price. A lot of the time, the creation of a fair value gap, let's say this is on New York, price will come and respect this fair value gap. So the respect would be mostly on New York. So if you are trading on London, you might lose. If you trade on Asian into this fair value gap, you might lose. Even though it's a valid fair value gap, I understand that. However, you want to enter on the fair value gap on the right time, which is the same time that the fair value gap is created. Okay, so if this was on London, then the real move is going to happen on London a lot of the time. So now I'm not saying 100% of the time, but a lot of the time, the real move is going to happen at this time. And I'm going to show you some examples. Now, one way of looking at it is this. Another way, you might actually win the trade. It might be a winner. However, it's going to be doing this. So this is New York. This happened on New York. Price is coming in the Asian session. You entered already, but it was doing this. London came, it was doing this. Then New York came, and then the real move start happening. Even though you were not out of the trade, however, you could have saved a lot of time just entering from the New York session itself. You would be protecting yourself from being stopped out because price could actually do this sweep going up, right? So a lot of the time, the respect of a fair value gap or the reaction of that fair value gap is going to happen on the same session or on the same timing on the 90 minutes. So now if we go right above on the 90-minute time frame and look at this, for example, looking at this example here, this is a fair value gap that was created at what time? 8 a.m. Price came to that fair value gap at what time? 21, 23, basically the Asian session, not much respect, started going lower. On the Atlantic kill zone, we had on, mostly on the low time frame, a market such a shift, and maybe a lot of people were trusting a fair value gap here. But what happened after? When did price had the real respect of that fair value gap? So fair value gap created at what time? 8 a.m. When was it respected? Exactly at 8 a.m. So price came back to that fair value gap at 8 a.m. The real move started happening. Now again, the same thing if we go here, and this is a trade that I entered also in Discord. So this is a fair value gap. What time was it created? 9:30. Did price came to this fair value gap at 9:30? No, actually this was New York. This is Asian, and you see it was not really respected. Price started going lower. You lost a trade here. Now let's say you entered based on London and you get a change of state delivery on the lower time frame. Now this one you thought, okay, now I caught the trade. However, it was not really the real move. Price started going up, came lower, nothing really interesting here. And then what happened? So this is 9:30. Price did not actually respect that fair value gap at 9:30. Then what happened after this extreme fair value gap? What time was it created? This one at 8 a.m. Price after 7 a.m. came, and then exactly at 8 a.m. decided to go lower into that fair value gap and started going up. So you see when the real respect happened. Now sometimes it's not going to be the exact time every time. However, it could be the exact kill zone, right? So this is a fair value gap at 9:30. Price came to that fair value gap at 8 a.m. So, and again, what time? 9:30. So this time at 9:30, this could be the real move. However, you just want to know that, okay, at the same kill zone, it's good, right? So if it came back to the same fair value gap at the same kill zone, then that's perfect. If it's at the exact same time, then that's even better. That's the end of the video, fam. So hopefully I was able to add something new to your knowledge. I gave you 7 smart money traps in order to avoiding those will give you a higher win rate. It's going to actually improve your way of trading, improve the way you look at the market. So hopefully this was valuable. If you guys want to support, then make sure to hit the like button, subscribe to the channel, leave a comment, and also join the Discord. It's a free Discord. We share a lot of knowledge there, a lot of educational stuff there, as well as free seminars. So make sure to join there. Again, hit the like button. I'll see you next video.